Are you familiar with the term tokenomics? Are you considering or have you invested into Ethereum? In this video, we will dive into Ethereum's tokenomics and how it resembles the Fed's ability to inflate the dollar rather than preserve value. We will answer this and a few more concerns we ran into when we considered investing into Ethereum. The term tokenomics refers to the system of how cryptocurrency tokens work within the broader crypto ecosystem. It's the process that underlies a token's creation, management, and potential growth. In the case of Ethereum, it's a little more complex. Ethereum's tokenomics involves a process known as mining. Miners solve complex mathematical problems to validate transactions and add them to the Ethereum blockchain. In return, they receive Ether, the native token of Ethereum. Unlike Bitcoin, whose value is derived from the scarcity of its 21 million tokens, Ethereum unfortunately has no hard cap. You would be correct if you said this sounds a bit like the Federal Reserve's ability to print money. However, this is even more concerning because it directly undermines the intent of blockchain to liberate our money and preserve its value. This means, theoretically, the possibility of printing Ethereum to zero, or at least deflating its value, exists within the very design of the network. One might argue that the absence of a maximum supply limit isn't inherently a flaw. After all, it could help maintain network security by incentivizing miners. However, history shows that this particular approach poses a significant risk of future inflation. Simple supply-demand economics says the more Ethereum in circulation, the less valuable it becomes. Need proof? Take a look at the American dollar. Designing cryptocurrency networks this way is dangerous. Utilizing blockchain's ability to maintain a fixed supply for value preservation is crucial. This solves our real-world problem of wealth acquisition and preservation of that wealth. It seems the Ethereum network somehow missed the memo on where value is derived. After all, the fundamental attribute that makes gold itself valuable is the limited supply. So while Ethereum might not be printing money per se, the effect could be strikingly similar. Let's not repeat the same mistakes that are causing our current economic problems. Oh, wait, but the issues don't stop there. Ethereum's system also allows for what's infamously known as front-running. This one really bothers me, and it should bother you too. Ethereum miners have the unsettling power to see your transactions before they're even locked into the blockchain. By peeking at your moves, they can execute identical transactions ahead of yours, buying the tokens you want only to sell them back to you at inflated prices. This tactic, known as front-running, effectively allows miners to jump the queue and exploit their position for profit.
This, right? So there's lots of little things like that. There's also things that involve like front-running other people's transactions. So one example of this would be that if someone sends a transaction that says, like, I don't know, buy me 5 ETH for whatever price that you can get, but with a maximum of let's say $15,000, then you can go and you can put a transaction right in front of that transaction, and you can buy up that ETH first, and then you resell it to him at $15,000 minus one.
Can anyone say scam? It feels exactly like one, as it undermines fair trading by placing miner interests blatantly ahead of yours. Shockingly, this isn't just unfair, it's celebrated as a feature. Daily business in the world of Ethereum transactions. In essence, the miners are jumping in the queue, and in the process, stealing a slice of your purchasing power or profits. However you want to view it, I'll leave up to you. It's akin to seeing someone's hand in poker before placing your bet, not exactly playing fair. In fact, when it involves money, it's outright ripping you off as part of the process. Blockchain doesn't need to operate this way in any sense. Does this resonate with the mantra of blockchain? Sorry to say, no. Here on Ethereum, freedom of money is compromised with all these middlemen taking fees from what are supposed to be peer-to-peer transactions. Congratulations, Ethereum. You've reintroduced middlemen into the system. I guess my question is, aren't we supposed to be moving away from middlemen and centralized control towards coveted decentralization and transparency? Let's move on and take a look at how staking works on Ethereum. Ethereum requires you to turn over or send your tokens to another person and lock them up. Yes, you heard right. In the fast-paced, ever-changing world of blockchain, you don't have access to your funds. Can someone say, not your keys, not your crypto? This is unwise considering the global reach and inherently risky nature of blockchain. Ethereum's proof-of-stake protocol locks your funds. In return, you receive interest. It sounds good in theory, but there's a catch. I see 2 red flags with this process. Red flag number 1, never send your funds to anyone for any reason. After all, this is an unregulated space. Not your keys, not your crypto. Remember this rule. Red flag number 2, your funds are locked out of your control. You just lost one of your fundamental rights. If the funds are locked, you can't move them. You are at the whim of the market. As an added bonus, if the autonomous network suspects any foul play, your stake can be slashed, and you can lose a portion of your funds. Can you say scam again? Blockchain is powerful and offers a range of possibilities to improve our current economy. The question I have is, why play the crypto game like this? Especially if other networks offer better and safer ways to do the exact same thing. Truly, the potential returns don't justify the risk. Sorry, Ethereum, you're just not making a good case to hold my money. I care about value preservation and risk of my assets. So, in a nutshell, Ethereum's tokenomics has some serious flaws. If you are a degen, you might love it. If you're a regular person like me and trying to create wealth and a passive income, this might not be what you're looking for in blockchain. I certainly know I don't want middlemen between me and my money or assets. The lack of a supply cap or limit introduces a powerful future risk of inflation. Front-running allows for unfair practices. Middlemen don't belong in blockchain. Staking riddled with risky practices and slashing can lead to substantial losses. The reason we created this video is because in the world of crypto, it is crucial to understand the underlying mechanisms of your favorite blockchain before investing. Ethereum, while innovative and widely used, clearly has purposefully built in serious risks. A slogan like "move fast and break things" begs the question, is the one using the network, the thing, being broken? Remember, this is your money after all. Ethereum's tokenomics is riddled with potential pitfalls that any potential investor should be aware of. So the next time you think about diving into Ethereum, remember these points and invest wisely, because in the end, knowledge is power. When we learned this was how it worked, we stopped using Ethereum altogether. The more research you do, the more you will realize it's not just investment decisions we are making here. We are shaping our global economic future. Wow, that was an eye-opener. Fear not, though. The ability to liberate your money does exist within blockchain. In our next video, we will be looking into how blockchain can empower you. If you like this kind of content, please consider the like and subscribe button so we know we are on the right track. If you want to learn more, head over to cardanomint.com and learn how to view blockchain from a different lens. Cheers, everyone, and thanks again!